In exactly 96 hours, a $32 billion financial empire evaporated. FTX was marketed as the high-quality, global exchange the world needed, a reputable face for an industry often criticized for a lack of transparency. That promise of safety helped the company reach a peak valuation of $32 billion. The public face of that valuation was Sam Bankman-Fried. Known universally as SBF, he often appeared in rumpled t-shirts and cargo shorts, projecting the image of an unpretentious gamer rather than a traditional corporate executive. He was the son of 2 Stanford law professors and a graduate of the Massachusetts Institute of Technology. After university, he spent 3 years as a trader at the elite Wall Street firm Jane Street, a background that gave him immediate standing within the financial establishment. This combination of elite institutional backing and a persona centered on effective altruism created an air of being beyond reproach. He pledged to donate his accruing wealth to global charities, a public mission that served as a powerful defense against corporate scrutiny. In 2017, the cryptocurrency market was highly fragmented and volatile. Because it lacked a centralized global ledger, the same asset often traded at different prices depending on the exchange. Bankman-Fried spotted a specific opportunity in Japan. While Bitcoin was trading for one price in the US, it was selling for nearly 10% more on Japanese exchanges. He utilized a strategy called arbitrage, buying Bitcoin at a lower price in one market and simultaneously selling it at a higher price in another, pocketing the difference. He founded a trading firm called Alameda Research to scale this trade. By moving up to $25 million every day across borders, the firm generated $20 million in profit with minimal market risk. These early, high-volume successes established Alameda as a major liquidity provider in the crypto space. It provided the capital and the momentum for Bankman-Fried to move beyond trading and launch his own centralized exchange. In 2019, Bankman-Fried co-founded FTX, moving from a trader on other platforms to the owner of his own digital marketplace. FTX targeted sophisticated traders by offering complex financial instruments like derivatives and options. Within 2 years, the platform's daily trading volume climbed to an average of $15 billion. The company's growth was fueled by an aggressive marketing campaign featuring high-profile ambassadors like Tom Brady and Stephen Curry. These celebrity partnerships were designed to signal that FTX was a safe, trustworthy destination for mainstream investors. In 2021, the company moved its corporate headquarters to the Bahamas. Bankman-Fried cited the nation's forward-looking stance on crypto regulation, a move that placed the exchange's core operations in a lightly regulated jurisdiction. This relentless public relations campaign helped FTX secure funding from elite financial players like Sequoia Capital and BlackRock. By 2022, these firms had valued the 3-year-old exchange at $32 billion, effectively endorsing the platform's stability to the rest of the market. Internally, the company lacked the basic controls expected of a multi-billion-dollar firm. FTX operated without a chief financial officer, managed its accounts on small business software like QuickBooks, and approved major corporate expenses using chat emojis on Slack. The platform's code contained a specific hidden exception. In 2019, Bankman-Fried directed his lead engineer to write a custom script, allowing Alameda Research to carry a negative balance on the FTX exchange. This enabled Alameda to withdraw billions of dollars new customer deposits to fund trading operations, repay lenders, and cover massive losses. To maintain the appearance of solvency, Bankman-Fried used FTT, a digital token created out of thin air. Alameda held billions of dollars in FTT and used it as collateral to take out loans, essentially propping up its balance sheet with a coin whose value was controlled by its own sister company. This meant the exchange's multi-billion-dollar valuation was a mirage. If the price of FTT broke, Alameda would face insolvency, and because the firms were so deeply entwined, the collapse would consume the customer funds on FTX as well. On November 2, 2022, the publication CoinDesk published a leaked balance sheet from Alameda Research. It revealed that the firm's single largest asset was billions of dollars in FTT tokens, exposing the structural vulnerability of Bankman-Fried's empire. 4 days later, the CEO of rival exchange Binance announced he was liquidating all of his company's FTT holdings. This triggered a massive sell-off, causing the price of FTT to plummet by 80% in 48 hours. As the token's value crashed, a run on the exchange began. Terrified customers attempted to withdraw $6 billion in just 72 hours, but because their funds had been funneled to Alameda, the money was no longer there. FTX was forced to freeze all withdrawals and file for Chapter 11 bankruptcy. Bankman-Fried resigned as CEO, and within a week, one of the world's largest crypto exchanges had completely shuttered. The rapid descent revealed that the savior of crypto had been operating a modernized Ponzi scheme, using the deposits of new customers to mask the multi-billion-dollar hole left by Alameda's reckless gambling. John J. Ray III, the corporate restructuring expert who took over the firm, described the situation as a complete failure of corporate controls. He testified that he had never seen such a total absence of trustworthy financial information in his career. The legal fallout was swift. In November 2023, a jury found Sam Bankman-Fried guilty on 7 counts of fraud, conspiracy, and money laundering. He was sentenced to 25 years in federal prison. However, the case concluded with a highly unusual turn for the victims. By liquidating Alameda's investments and benefiting from a massive recovery in the crypto market, bankruptcy lawyers announced they would be able to repay customers in full. There is a bitter irony in the resolution. The risky, illiquid venture bets Bankman-Fried made with stolen customer funds ultimately appreciated enough in value to cover the massive hole he had created. The collapse of FTX serves as a warning about the risks of unregulated centralization and the power of a carefully constructed public image. It demonstrates that the most significant financial failures are carried out by those who use a narrative of altruism to avoid basic institutional oversight.